Picture this. You've been renting for 5 years. You're paying £1,200 a month in rent, money that disappears into someone else's pocket. You finally save up a deposit. You find your dream house. You put in an offer. The seller accepts. Then you go to the bank for a mortgage, and they say, "Sorry, we can't lend to you." Sound familiar? Here's the brutal truth. Buying a house in the UK is one of the most stressful, confusing, and expensive things you'll ever do. And most first-time buyers have no idea what they're doing until it's too late. The average UK house price is now £285,000. You need a deposit of at least £28,500, and that's just the start. In the next 13 minutes, I'm going to show you exactly how the UK mortgage system works, how much you actually need to save, the step-by-step process from application to keys in hand, and the 5 mistakes that cost first-time buyers thousands. Let's get into it. All right, so what actually is a mortgage in the UK? Think of it as a long-term loan from a bank or building society to buy a property. You borrow most of the money, and you pay it back over 25 to 35 years with interest. Here's how it works. Let's say you want to buy a house for £250,000. You save up a £25,000 deposit. That's 10%. The bank lends you the remaining £225,000. That's your mortgage. The amount you borrow is called the loan-to-value ratio, or LTV. In this case, you're borrowing 90% of the property value, so your LTV is 90%. Here's the key point. The lower your LTV, the better the interest rate you'll get. 60% LTV, 40% deposit, equal sign. Best rates, around 4 to 5%. 75% LTV, 25% deposit, equal sign. Good rates, around 5 to 6%. 90% LTV, 10% deposit, equal sign. Higher rates, around 6 to 7%. 95% LTV, 5% deposit, equal sign. Highest rates, around 7 to 8%. So saving a bigger deposit doesn't just reduce your monthly payments. It gets you a better interest rate, which saves you tens of thousands over the life of the mortgage. But here's the thing. Most first-time buyers struggle to save even a 10% deposit. That's why the UK government has schemes to help, and I'll show you those in a minute. First, let's talk about how much you actually need to buy a house. So how much do you actually need to buy a house in the UK? Let's break it down. Cost 1. The deposit 5 to 20% of property price. This is the big one. For a £250,000 house, 5% deposit, equal sign, £12,500, 95% LTV, highest rates, a 10% deposit, equal sign, £25,000, 90% LTV, good rates, 15% deposit, equal sign, £37,500, 85% LTV, better rates. A 20% deposit, equal sign, £50,000, 80% LTV, best rates. Cost 2. Stamp duty 0 to 5% of property price. This is a tax you pay when buying a property. But here's the good news. First-time buyers don't pay stamp duty on properties up to £425,000. So if you're buying your first home for £250,000, you pay 0 stamp duty. That saves you £2,500. If you're buying a property over £425,000 as a first-time buyer, you pay 5% on the portion above £425,000. So if you buy for £500,000, you pay 5% on £75,000, equal sign £3,750. Cost 3. Survey £300, £1,500. Before you buy, you should get a survey to check the property for structural issues. There are 3 levels. Level 1 condition report, £300, £400. Basic overview, Level 2 home buyer report, £500, £800. More detailed, most common Level 3 building survey, £1,000, £1,500. Comprehensive for older properties. Cost 4. Legal fees £1,000, £2,000. You need a solicitor or conveyancer to handle the legal work. They check the title, search for issues, and handle the transfer of ownership. Cost 5. Mortgage arrangement fee £0, £2,000. Some lenders charge a fee to set up the mortgage. This can be added to your loan or paid up front. Cost 6. Valuation fee £0, £1,500. The lender will value the property to make sure it's worth what you're paying. Some lenders do this for free. So let's add it all up for a £250,000 property with a 10% deposit. Deposit, £25,000 stamp duty, £0 first-time buyer. Survey, £600. Legal fees, £1,500. Mortgage arrangement fee, £1,000. Valuation fee, £0. Some lenders include this. Total, around £28,100. That's your realistic starting point. Not just the deposit, all the costs combined. And that doesn't include moving costs, furniture, or repairs. So aim to save £30,000, £35,000 to be safe. Now, how do you actually get a mortgage? All right, so how do you actually get a mortgage? Here's the step-by-step process. Step 1. Check your credit score. This is where we come full circle from the last video. Your credit score is critical. Most lenders want a score of at least 620 to 650 out of 999 for a standard mortgage. If your score is lower, you might still get approved, but you'll face higher interest rates. Check your score on Experian, ClearScore, or Credit Karma. If it's below 620, spend 3 to 6 months improving it before you apply. Step 2. Work out how much you can borrow. Lenders typically lend 4.5 times your annual income. So if you earn £35,000, you can probably borrow £140,000, £157,500. If you're buying with a partner, they'll add your incomes together. 2 people earning £35,000 each could borrow around £280,000, £315,000. But here's the thing. Lenders also look at your outgoings, rent, loans, credit card payments, childcare, etc. High outgoings reduce how much you can borrow. Use an online mortgage calculator to get a rough idea. Or speak to a mortgage broker who can give you a more accurate figure. Step 3. Get agreement in principle AIP. This is also called a decision in principle or mortgage in principle. It's a statement from a lender saying they're willing to lend you a certain amount, subject to full approval. You can get an AIP from most lenders in 10 to 15 minutes, often online. It doesn't guarantee you'll get the mortgage, but it shows estate agents and sellers you're serious. Important, getting an AIP usually involves a soft search that doesn't affect your credit score. But some lenders do a hard search, so check first. Step 4. Find a property and make an offer. Once you have your AIP, start viewing properties. When you find one you like, make an offer through the estate agent. Here's a tip. Don't be afraid to offer below the asking price. In a slow market, you might get 5 to 10% off. In a hot market, you might need to offer at or above asking price. If your offer is accepted, you're sold subject to contract, but nothing is legally binding yet. Step 5. Choose a mortgage and apply. Now you formally apply for a mortgage. You can go direct to a lender bank, building society. Use a mortgage broker recommended for first-time buyers. Use an online broker like Habito, L&C, or Money Supermarket. A mortgage broker can access deals from the whole market and help you navigate the process. They're paid by the lender usually, so it's free for you. You'll need to provide proof of identity passport, driving license, proof of address, utility bills, council tax bills, proof of income payslips, P60, bank statements, proof of deposit bank statements showing savings. Details of the property you're buying. Step 6. Lender valuation and survey. The lender will value the property to make sure it's worth what you're paying. This is for their protection, not yours. You should also get your own survey, as I mentioned earlier, to check for structural issues. If the survey reveals problems, you can renegotiate the price or walk away. Step 7. Legal work conveyancing. Your solicitor will check the property title, carry out local searches planning, environmental, drainage, review the contract, handle the transfer of funds, register you as the new owner. This takes 8-12 weeks on average. Step 8. Exchange contracts and completion. This is the final stage, exchange of contracts. Both you and the seller sign the contract. Now it's legally binding. If you pull out, you lose your deposit. If the seller pulls out, they can be sued in completion. Completion, the money transfers, and you get the keys. Usually 1 to 2 weeks after exchange, but can be same day. And that's it. You're a homeowner. But before you rush off to apply, let me show you the different types of mortgages available, because choosing the right one can save you thousands. All right, so what types of mortgages are available in the UK? Type 1. Fixed rate mortgage. Your interest rate is fixed for a set period, usually 2, 5, or 10 years. Your monthly payments stay the same, no matter what happens to market rates. Pros: predictability. You know exactly what you're paying. Cons: if market rates fall, you're stuck paying more. If you want to switch or pay off early, you'll pay an exit fee, usually 1 to 5% of the remaining balance. This is the most popular choice for first-time buyers because it gives you certainty. Type 2. Tracker mortgage. Your interest rate tracks the Bank of England base rate, usually at a set percentage above it. So if the base rate is 5% and your tracker is base rate plus 2%, your rate is 7%. Pros: if base rates fall, your payments fall. Cons: if base rates rise, your payments rise. Less predictable than fixed. This can be good if you think rates will fall in the next few years. Type 3. Discount mortgage. You get a discount off the lender's standard variable rate SVR for a set period. So if the SVR is 8% and you get a 2% discount, your rate is 6%. Pros: similar to tracker. If SVR falls, you pay less. Cons: SVR can change at the lender's discretion, so less predictable. Type 4. Offset mortgage. This is more advanced. You link your mortgage to your savings account. The savings are offset against your mortgage balance, so you only pay interest on the difference. Example: you owe £200,000 on your mortgage and have £20,000 in savings. You only pay interest on £180,000. Pros: reduces interest paid, flexible, you can still access your savings. Cons: usually only available with larger deposits, rates can be higher. For most first-time buyers, a 2-year or 5-year fixed-rate mortgage is the safest choice. It gives you certainty while you get settled. After the fixed period ends, you'll move on to the lender's SVR, which is usually much higher. That's when you remortgage, either with your current lender or switch to a new deal. But here's the thing. Most first-time buyers don't qualify for the best deals because they have small deposits or thin credit files. That's why the government has schemes to help. All right, so what government schemes are available to help first-time buyers in the UK? Scheme 1. Lifetime ISA LISA. We covered this in the ISA video, but it's worth mentioning again. If you're 18 to 39 and saving for your first home up to £450,000, you can put up to £4,000 per year into a lifetime ISA. The government adds a 25% bonus, so £1,000 free every year. Over 4 to 5 years, that's £4,000, £5,000 in free money toward your deposit. Scheme 2. Help to Buy. Equity loan ended for new applications. This scheme closed to new applications in October 2023, so it's no longer available. But you might see it mentioned in older articles. Just know it's gone. Scheme 3. Shared ownership. You buy a share of a property, usually 2.5-7.5%, and pay rent on the rest. This is aimed at people who can't afford a full mortgage. Pros: lower deposit needed, lower mortgage. Cons: you don't own the whole property. Rent can increase, harder to sell. This is available through housing associations. Check gov.uk/shared ownership for details. Scheme 4. First Homes Scheme. This is for first-time buyers and key workers, NHS, military, teachers. You get a 30-50% discount on a new build home. The discount is passed on to future buyers when you sell. Pros: significant discount, lower deposit needed. Cons: only available on new build properties in specific developments, restrictions on selling. Scheme 5. Right to buy for council tenants. If you've been a council tenant for 3+ years, you might be able to buy your home at a discount of up to £116,200 outside London or £154,900 London. Pros: huge discount. You already live there. Cons: only for council tenants, property must be your main home. The Lifetime ISA is probably the most accessible scheme for most people. If you're saving for a first home, open a LISA today. It's free money. For the other schemes, check gov.uk to see if you qualify. Now, let me warn you about the biggest mistakes first-time buyers make. Right. Before you go house hunting, I need to warn you about the 5 biggest mistakes that cost first-time buyers thousands. Mistake number 1. Not getting a decision in principle first. I see this all the time. Someone finds their dream house, puts in an offer, gets accepted, then goes to the bank and gets rejected for a mortgage. Now you've wasted time, maybe paid for a survey, and lost the property. Get your AIP before you start viewing. It takes 10 minutes and shows sellers you're serious. Mistake number 2. Borrowing the maximum you can. Just because a lender will lend you £300,000 doesn't mean you should borrow £300,000. Think about your monthly budget. Can you afford the mortgage payments and still pay your bills, save for retirement, and have a life? A good rule of thumb? Your mortgage shouldn't exceed 3.5 times your annual income. If you earn £35,000, aim for a mortgage of £105,000, £122,500, not the maximum £157,500. Mistake number 3. Skipping the survey. The lender's valuation is for their protection, not yours. It just checks the property is worth what you're paying. You need your own survey to check for structural issues, damp, subsidence, roof problems, etc. If you skip the survey and the house has £20,000 in repairs needed, that's £20,000 you didn't budget for. Always get a survey. It costs £5, £100, £800, but can save you tens of thousands. Mistake number 4. Not factor in all the costs. I showed you earlier that buying a £250,000 house costs around £28,100 in total, not just the £25,000 deposit. But most first-time buyers only save for the deposit. Then they're short on stamp duty, legal fees, survey costs, moving costs, furniture, repairs. Save at least 15% more than you think you need. Better to have £35,000 saved than £28,000 and be scrambling at the last minute. Mistake number 5. Not shopping around for a mortgage. Different lenders offer different rates, fees, and deals. The difference between a 5% rate and a 6% rate on a £200,000 mortgage over 25 years is over £35,000. Don't just go with your bank. Use a mortgage broker or compare deals online. Even a 0.5% difference in rate can save you thousands over the life of the mortgage. Avoid these 5 mistakes and you're already ahead of most first-time buyers. All right, so how long does the whole process take? Saving for deposit. 2 to 5 years depending on how much you earn and save getting agreement in principle. 1 day if you have good credit finding a property, 1 to 6 months, offer to completion, 3 to 6 months, average 4 months. So from start to finish, you're looking at 2 to 5 years of saving, then 10 months of active house hunting and mortgage application. If you start saving today and can put away £500 per month, you'll have a 10% deposit, £25,000 on a £250,000 house in about 4 years. Not quick, but it's realistic. Right, so here's your action plan to buy your first home in the UK. Step 1. Check your credit score. Sign up for Experian, ClearScore, and Credit Karma, all free. If your score is below 620, spend 3 to 6 months improving it before you apply for a mortgage. Step 2. Start saving for a deposit. Open a lifetime ISA if you're eligible 1839, first home up to £450K. The government adds 25% bonus, free money. Aim for at least a 10% deposit. The more you save, the better your mortgage rate. Step 3. Get agreement in principle. Once your credit score is good and you have some savings, get an AIP from a lender. This takes 10 minutes and shows sellers you're serious. Step 4. Use a mortgage broker. Don't try to navigate this alone. A good broker can find you better deals and guide you through the process. Step 5. Start viewing properties. Once you have your AIP and a broker, start viewing. Make offers when you find something you like. Step 6. Budget for all costs. Remember, it's not just the deposit. Budget for stamp duty, if applicable, survey, legal fees, moving costs, furniture, and repairs. If you follow this plan, you'll be a homeowner within 2 to 5 years. It's not quick, but it's realistic. And the sooner you start, the sooner you'll have the keys in your hand. If this video helped you, please subscribe. Every week I'm putting out videos exactly like this one, UK-specific money advice that actually works. Hit the bell too, so you don't miss the next one. Thanks so much for watching. I'll see you in the next one.